Dovah Trades, what's good? All right, so I made a cheat sheet to help with risk management for anyone who's just getting into investing, not sure how to manage risk. You hear a lot about it on YouTube videos. You should manage risk, risk this percentage of your account on a trade, but no one really tells you how to do it. So that's what I've done here. Take a screenshot of this, copy this down, whatever you got to do before we jump into it. We're going to give examples, and at the end I'm going to show you how to put this into a spreadsheet so that you don't have to remember any of this video. You can just type in your potential trades into a spreadsheet and see, how much risk you should be taking and all this stuff. So, what is risk management? So, if I buy $700 worth of stock, am I risking $700? What is the only way you can lose that whole $700 is if the price goes down to zero. And that's usually not going to happen. You're only risking a percentage of the money that you invest into a certain stock. That risk is determined by how many shares you're buying and how low you're willing to let that price go before you sell. It's probably not going to go to zero. It's going to be somewhere in between zero and where you got in. So I drew up these equations to try and help you determine how much you should be risking in your trades and how you can risk a certain amount of money per trade. So this here is a basic profit-loss equation for a single trade. Okay, so we'll go through these variables. P/L stands for profit or loss. It's going to be positive if you came out with a profit on the trade and negative if you came out with a loss on the trade. And for purposes of this video and these examples, they're all going to be negative. So P/L is always going to be negative today because we're talking about how much we're willing to lose. That's what risk management is about. Okay, Q is the quantity of shares that you're buying and selling, also known as your position size. P sub B is the buy price. P sub S is the sell price. So this is a pretty basic equation for that. I'll say it in plain words. So profit or loss is equal to the quantity of shares times the sell price minus the quantity of shares times the buy price. And yeah, keep in mind that P/L will be positive or negative depending on whether or not your buy price and your sell price, which one's higher. It's going to determine whether or not you profited or lost on the trade. That makes sense, right? Intuitive sense. So next, I did some algebra. Don't worry if your algebra skills are rusty. I've done all that here for you. That's why this is a cheat sheet. So if you know how much you want to risk, so you know what your PL is going to be, you know your buy price and you know your sell price, then all you have to figure out is how many shares you're going to risk or how many shares you're going to buy when you enter the trade and sell when you exit. So this is the equation you would use for that. It's the profit/loss over the sell price minus the buy price. And if you use this equation and you end up getting a negative, you either forgot to put the negative in front of the P/L or you got the buy price and sell price mixed up. But the number value is going to be correct. So if you get negative 10, it's 10. That's a minor mistake. If you use this and you end up with a negative, just flip it around. Now the other thing we can do by manipulating that first profit-loss equation is find out what our sell price is going to be if we know how many shares we're going to buy and sell. So that first equation there, P sub S equals P/L over Q plus P sub B. That's going to help you calculate your sell price. It's the potential loss over the number of shares plus the buy price, and that P over L or P/L over Q is going to end up being negative because we're taking a loss. And if you're not comfortable using negative numbers for this, you can use that bottom equation and just use all positive numbers. Dealing with negatives can be a bit tricky, so for those who are less comfortable with negative numbers, use that bottom equation there. P sub S equals P sub B minus P/L over Q. Okay. And just a couple of caveats. for using these equations. One limitation of this is that Q is fixed. So you're always buying and selling the same amount of shares, which is not always the case. I personally did a trade the other day when I bought 100 shares. I made some profit, and I sold 90. So I didn't buy and sell the same amount of shares. So Q is changing. You're not going to be able to do that with these equations. That's a slightly more sophisticated risk management strategy, but that's okay. This is a very beginner intro thing to just help you start thinking about risk management and actually being able to do it in your trades. Okay, so you can use these equations to calculate what your risk is going to be, find acceptable stop loss prices, and calculate how many shares you should be trading, sizing your bets appropriately. So just to really drive home when to use each of these, if you know the buy price, the sell price, and how much you're willing to risk, the only thing you need to find out is how many shares you want to buy. And so you use the Q formula for that. And if you know the buy price, how much you're willing to risk, and how many shares you want, you need to find your stop price, your stop loss, and use the P sub S formula. Again, if you're comfortable with negatives, you can. If you're comfortable with negatives, you can use that top one. If you don't like negatives, you can use the bottom one. Now, just again, more caveats. In my personal opinion, you should place your stops based on your theory of the trade. So finding your stops shouldn't be purely based on these formulas. You should know when you're wrong. So if I'm seeing a trade, a stock that's going up, and I think it's going to keep going up, and I get in, I have to set a price to where, okay, if it goes down here, I know I'm wrong. I know I'm wrong about this uptrend, and I want to get out. So again, your stop should be tied to your theory of the trade. You should know if the price goes down by this much, I'm wrong. I just need to get out. But these are still useful formulas for seeing how much you're risking with different position sizes, and hopefully you can use these. So let's start with an example. We've got a $2,000 account, and we're willing to risk 1%, which I know it does not sound like a lot, but 1% can be a lot. I personally have been using less than 1%, risking less than 1% on my trades. I used to risk 2% when I first started out, and that was definitely too much to start. So, but 1% is easy for math, so we're doing that here. We're looking at GameStop, right? And we think GameStop is gonna continue this uptrend. We think it's on an uptrend. So right now it's at $7, and we're thinking, we think it's on an uptrend, but if it gets down to $5, pretty sure that we're wrong and we should get out of the trade. So it's at $7, we want to get in, and if it goes down to $5, we want to get out, and we only want to risk $20 or 1% of our account equity. Remember, you're not risking all of the money that you put in. So if I'm, buying, I don't know, 100 shares, then it's 100 times 7, right? $7. That's $700. I'm not actually risking $700 because there's a very little, probably impossible that it's going to go down to $0. It can happen, but unlikely that the stock's going to go down to $0. So I'm not actually risking $700. But anyway, back to the example. So you're willing to risk $20. So our acceptable loss is -20. Okay. So how many shares should you buy? At this point, you can pause the video and use the cheat sheet to try and figure it out. I will now scroll down and show you the answer. So if we plug in our formulas here, we would use the Q formula. We've got all the numbers we need. Our acceptable loss is 20, sell price is $5, buy price is $7. That simplifies down to -20 over -2. The negatives cancel out. You're left with 10 shares. And again, if you got -10 shares, it just means you either forgot the negative on the P/L or you mixed up the buy and sell price. And it's the same number. If you want to simplify it, don't get confused now. Just forget this if you get confused. If you want to totally get rid of negatives, you don't want to work with any negatives, switch around the buy and sell price. So then you'll have profit loss over buy price minus sell price, and then you don't have to use any negative numbers, and you'll always get a positive number. If that confused you, don't worry about it. Just forget I said it. Okay, so 10 shares is not a lot of shares. If we're right, we're not going to make very much money. So let's say we want to up the ante a little bit, and we're committed now to buying 100 shares. Same account, $2,000, still willing to risk $20. We're still looking at GameStop. Same thing, looks like it could be on an uptrend. But if we want to risk that same $20 and we're buying 100 shares, where should our stop be? It's going to be much closer to our entry price because we're buying so many more shares. So for every tick that the stock moves, it's going to be a bigger effect on our account if we're buying more shares. So intuitively, we should know that the stop should be higher than $5. So again, we're willing to risk 1% or $20. We're committed to using 100 shares. So what should our stop price be? If this trade goes against us, where do we get out? What's the point where we cut losses and forget about it and move on? So again, I'll pause the video here, and you can use the cheat sheet to try and figure out what this should be. And I'm going to scroll down and show you now, show you the answer. We would use our P sub S formula, plug in our numbers. Our loss would be -20 divided by 100 shares plus our entry price of $7. That simplifies down. -20 divided by 100 is -0.2. Adding a negative is the same as subtracting. So it would be our entry price minus 0.2, or 680. And if you messed up the negatives on this one, you'd probably get 720. And you'd probably add that 0.2 instead of subtract if you got the negatives wrong. So using the P sub S formula, you know you messed up if your sell price is higher than your buy price. So looking at these two examples, our first example, if we're wrong, we can be really, really wrong and lose $20. It can crash all the way down here to $5 and we've only lost $10. But if it goes in our favor, we're not going to make very much because we only bought 10 shares. In this other example, if we're right, we got to be right away. We got to be right immediately, because if there's too much volatility or it dips back a little bit, we're going to get stopped out of the trade. But if it goes our way, we'll make a lot more money. And so this is risk management. This is figuring out how to size your trades, and again, you can decide how much to put in there. It's totally at your control. If you want to risk less than $20, more than $20, less than 1%, you're in total control. So it's worth playing with these equations a little bit when you're considering a trade. Know where you're going to get out before you get in. Before you get into a trade, have an exit strategy planned out ahead of time. That's just a personal bit of advice. And so now I promise to show you how to put this in an Excel spreadsheet so you don't have to do this by hand every time. This is a share calculator. You can play with this. I haven't made a stop price calculator specifically for these equations. I think this is just more useful. But so this is where you would plug in your equation. Right here is in this square. If you set it up like this, the ticker, buy price, stop price, and risk, your equation is up here, okay? D2 over B2 minus C2. And if you're keen, you'll notice I swapped the buy price and the sell price to get rid of that negative, because you see this would be my PL, my P/L, but that's positive. I'm not using negative numbers in my spreadsheet, so I switched around the buy price and the sell price in my equation to just get rid of that negative. And this if error function here makes it so that if these boxes are empty, it would normally show an error. And if it's an error, I say to just display 0. So you see here how there's nothing in these spaces, and so the equation is taking data from the squares, and since there's nothing, it would bring up an error. And I'm telling it, if you're coming up with an error, just say 0. And this other part here, round down, I'm telling the computer, if you want to spit out a decimal here, if you use this equation and you get, like, let's say this came out to 23.6, I'm telling it I want you to round down to 23. Okay, I'm being conservative because this is risk management after all. So anyway, I hope that helped out a little bit. I remember when I first was getting into it, I didn't understand what they meant by, risking a certain percentage of your account. I didn't really know how to do that. So hopefully this helps. Hopefully the cheat sheet helps. If you got any questions, you want me to go more in depth into the algebra or more in depth into Excel, let me know in the comments. But this has been Dovah Trades. Peace. I hope you're all doing well. Make some Dovah trades out there, whatever that means. I have no idea how to end these videos. All right, bye.